Welcome to Money Talk with Aaron Ricketts, presented by Ricketts and Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk with Aaron Ricketts are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial advisor, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Aaron's back with us once again.
Hi, John.
Well, we have another very important show that's on tap.
I think so.
And we're talking about health now, right?
Well, insurance, I guess, coverage, and just how to defer taxes.
Oh, cool.
But that's really a tax advantage, right?
Right.
It's a great tax advantage. Health savings account. Health savings account. I know I've talked about this, many times with my clients, and there's rules. You got to follow these rules. But if you follow these rules, to me, the health savings account might be one of the top investment options or strategies out there. And I say investment options because most health savings accounts, many of them, have investment options within them. But you got to build up a balance at some point. But the purpose of the health savings account is for you to save money and have a tax advantage where you won't pay tax on that money if the use of that money, future use, is for qualified health medical expenses. So many households inquire about health savings accounts. They say they get tons of questions about this. Banks do them, investment companies do them, there's large insurance companies that do them. So they get the questions, but they get very few that actually sign up. There's less and less, even though there's opportunity for people. So I just said that, and now I'm going to say 26 million people have HSAs, but the numbers are a lot higher that could have them. That's about 20 to 30% of those that could have an HSA that have one. Here's the kick, or the kicker. You must enroll in a high deductible health plan to have one. So what's a high deductible health plan? A high deductible health plan is a deductible that is $1,350 or higher for an individual, or $2,700 for a family. So a married couple or a family. In exchange for accepting the high deductible, you pay relatively low premiums for the coverage. So many companies, even governments that have employees, they have had traditional insurance for a long time. What they've done is, I say traditional insurance, something with a $500 deductible or a $1,000 deductible, not a high deductible. And what they've done is they've either offered another option for people to do the high deductible plan. It's pretty much the same coverage, you just have a higher deductible. And then what you do is the savings that you have from your premium that you're paying in, you put that into your health savings account. It's not rocket science. It's just something where you have to just do the math and figure out, is it or might it be in your best interest? I'll give you an example. Me. So me and my wife and my daughter, when she was on our health plan, wife 5 years ago, she's a school teacher, had the option to do a high deductible plan versus the traditional plan. They kept the traditional plan for those employees who want to keep it, but then they provided the high deductible plan. So we contributed the maximum, which is somewhere around $7,000 for a family this year. The last few years it was lower, but you can see that's a lot of money that you can put in. The deductible is $2,600 at that time for the family. I think it's $2,700 today, which I just said. So there was money that was carried over, could be carried over every year, and that could be for anybody. But the thing was, we never got above $2,700 or our deductible, or used our family deductible in that 5 years. Never. So you can see, if you don't have a claim, your insurance premium should be relatively cheap, because the fewer claims that an insurance company has for that pool of people, the cheaper it is for that pool of people. The premium is for your employer and for you, whatever your share is. In addition, then, that extra money that you put in, there's some coverages that or some things that the insurance company doesn't cover, and maybe your dental coverage is only up to $1,000, and maybe you have $2,000 or $3,000 worth of dental work. Well, you can use your HSA card, or they give you a debit card in essence, and you can use that for those expenses. And remember, it's tax deferred, but if you use it for qualified medical expenses, there's no tax at all. So you're never paying tax on that. So that could be a savings of 10, 12, 22%, your state tax 25% or more. It's very advantageous for people to have these things, even if they are using all of it or using up to their deductible. They still would probably have a cheaper premium. And again, you do the math. How much does it cost me? If there's 26 pay periods in a year for a biweekly wage earner, and you put in $100 a pay, there's your $2,600. Well, do the math on what the premium difference is, right? If the premium difference is $150 less, you just made another $50. That's the math that you have to do. And your HR people, they usually know all this stuff. You can just ask them and they'll tell you, here's what you're paying now, right? They'll go through your pay stub with you. And then this is how much it would be for the premium for a high deductible plan. And then you can do the math on how much you would have to contribute to at least get to cover the deductible, right? And then I suggest if you're doing a 401k or doing other stuff, think about putting more money into your HSA and maxing that out, especially as a family. It's a great plan, a great program, especially if you're a higher income earner. Now, they do phase out over certain amounts of income, but that's pretty high. It's quite a ways up there. So I said this year the individual can direct as much as $3,500 to an HSA, while a family can contribute $7,000. These caps are higher if you're 55 and older, so you can put another $1,000 in there for a family. So you could put $8,000 in there if you're 55 and older. So if that doesn't sound good enough, I'll give you something even better. At age 65, this thing in essence turns into an IRA. So you don't have to use it specifically for qualified medical expenses. So especially if you're over 50, you really want to think about doing this. There's a lot of money that you could save and going forward. And here's some of the other things. You can use that money to pay deductibles, which is what mainly we're talking about. You can have it pay for co-payments as long as and some hospitalization costs, as long as the doctor prescribes something, even if it's an over-the-counter medication, and you can just say, I want you to prescribe this if it's a regular, let's say, maintenance med that you're taking, but it's over the counter, which means you can just go in and buy it. Typically, the HSA says you have to have a doctor, either prescribe it, or it has to be a visit that you're on for the HSA to identify it as a qualified medical expense. So just have them write you out a prescription, and you have that as documentation. So in case there is an audit later on, you have something to show this is what I used that money for. My daughter got LASIK surgery. It was $4,500. Well, I had plenty of money in there saved up over a few years. So that was completely tax-free, that $4,500 LASIK surgery. And the list goes on and on and on. Some people have, some denture issues or caps or crowns, or you never know with dental and vision. There's always often some expenses. Many plans don't offer any dental insurance, or it's, you pay the first $500 out of pocket. So typically your cleanings aren't covered and stuff. So you don't have any insurance coverage. Your HSA can pick that up. I talked about when you turn 65, that it turns into an IRA. Now remember, if you take money out and it's after 65 and it's not a qualified medical expense, it has to go on your tax return because it's an IRA. It's just tax deferred. But that's where usually we're in a higher tax bracket when we're working, and we're in a lower tax bracket when we're not working. So keep that in mind. Deferring taxes typically is in your best interest, and it will always be in your favor, or can always be in your favor, as long as you can manage the taxes on the back end. Keep that in mind. I talked about. Let me look at some hurdles here. There's always a hurdle, isn't there? I talked about a lot of advantages. So, if you're a senior or a younger adult, remember you can't be over 65 and on Medicare, because it's not a high deductible plan. You have to be on a high deductible plan. But if you have a chronic condition or illness, and you might be taking all the money that you save in your HSA and paying towards your medical insurance, your medical needs, it might not be in your best interest, and it might not be in your as an objective for you to do the HSA. Your goal would be accumulation, would be to potentially grow this account in a tax-advantaged health savings account over time to use it in case of emergency. But then when you're 65, you can use it as an IRA if necessary.
It, like you said, it's almost always advantageous to defer taxes, just about in any situation.
Yes.
But, and like you said, for years, it sounds to me like you could be in a situation where you could start the plan and you might not wind up using any of it, and the money just builds up over 15 or 20 years and then turns into an IRA.
Yes, that's absolutely right.
And for those people that have incomes and they want to have the protection of being able to have extra money for their health care, sounds like a great idea.
Right, and you can open these up at most of the banks here in our local county. Of course, you can do brokerage accounts. There's different companies that will do these, and the big ones are the insurance related, because they're often connected to your insurance account. I know ours were. We were with Blue Cross, which is the teachers group was Mesa, and they actually connected to our Health Equity, which was our provider for the HSA. So when it's made it so easy, because the doctor copay, I go to the doctor copay would show up on my HSA account, and I would just have to click to pay, and it would just resolve it immediately and take care of it. It's very, very simple. Not all of them are like that, but they give you a debit card. So, you go down and pick your prescriptions up and you got a $20 copay. You just give them your debit card, your HSA debit card, and it resolves it immediately.
Well, if people want to get some more information on HSA, the advantages, and if perhaps they're in a situation like you alluded to just a moment ago, that perhaps maybe it's not advantageous for them, how can they do that?
Give me a call, 265-3540.
All right. Thanks, Aaron.
Thanks, John.
That's Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk with Aaron Ricketts are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate